Hello and welcome. We are now ready to begin today's webinar, Behavioral Economics, a Key to Understanding How Employees Make Equity Compensation and Financial Decisions. My name is Bethany Dennis. I'm with the Rutgers, New Jersey, New York Center for Employee Ownership. I'm going to be your host and moderator.
April 2012.
1 second. There we go. And I'm going to be your host and moderator today. So the webinar is scheduled for 45 minutes. Q&A is going to be at the end. So feel free to submit your questions in the chat and then I'll read them at the end. Participants, I'm going to ask you all to stay muted. And again, submit your questions in the Zoom chat and Bill will answer them at the end. So I'm going to introduce Dr. Bill Castellano. He's our speaker today. He is a professor of strategic HR management at Rutgers University's School of Management and Labor Relations. He's also the executive director for the New Jersey, New York Center for Employee Ownership. He's a fellow at the Rutgers Institute for the Study of Employee Ownership and Profit Sharing. Bill also serves as a board member of the Global Equity Organization, and his research, teaching, and consulting activities are focused on understanding the impact of employee ownership and equity compensation strategies on individual and organizational outcomes, employee engagement, and the effective management of human capital. Bill, we're so happy to have you here today. Go ahead.
Well, thank you, Bethany. It's a pleasure to be here with all of you. And for today's agenda, what I would like to talk about are understanding some of the common biases and heuristic principles that lead to poor decision-making, how behavioral finance impacts employees' financial decisions, and then we'll end by talking about how to design equity compensation programs to help employees make better financial decisions. And as Bethany mentioned, we'll have some time at the end for any questions. So do we think we are all rational? That's the classic question that many economists and financial theorists have been asking for generations. I mean, most traditional theories assume we're rational, that we use logic when making important decisions, particularly financial decisions. But the most recent thinking, primarily in behavioral economic theory, indicates that, well, that may not necessarily be the truth. We find that people rely on cognitive and emotional shortcuts that create biases. We have rules of thumbs, heuristic principles that help simplify complex probability judgments. And oftentimes this leads to severe and systematic errors. Also, under behavioral economic theory, we talk about prospect theory, which is an analysis of decision-making under risk, which is very applicable for today's presentation. Behavioral finance is a field of study that's based both on decision science as well as behavioral economics. And it too argues that when making financial decisions, people are not always very rational. They use the same biases and heuristic principles and even are influenced by emotions when making financial decisions. So both are really a derivative of decision science. And we've known for decades that we primarily have two systems ways of thinking. Most of us operate in systems one. It takes the least amount of effort. It's where we do use a lot of these shortcuts that we were making reference to. But again, this does lead to oftentimes systematic errors. Systems two requires a lot more effort. Now, we do use systems two when we need to concentrate and make important decisions. But unfortunately, most of us, even when making financial decisions, rely on systems one thinking. And it's not just about our judgments, right? The way our brains are wired, it even influences our ability to perceive things. Here's a classic example where you have two tables, which one looks longer? I mean, clearly A looks longer than B, but we know when we have these kinds of tests, the logical answer is that they're both the same size, and they are both the same size, but I literally had to take a ruler to verify that they were the same size. And I could show you countless other examples, even with colors and how we misclassify things based upon the context of the material. So we've known for a long time that we primarily do use systems one, even when confronted with logical type questions, math questions, and financial questions. The kinds of research looking at these studies use what we call the cognitive reflection test. This was given to countless individuals, many university students, over the years. And here's an example of 3 of the questions. So kind of test whether you have the ability to use systems 1 or systems 2 thinking. A bat and a ball cost $1.10. The bat cost $1 more than the ball. How much does the ball cost? A good number of students said 10 cents, when in fact the answer is 5 cents. In a lake, there is a patch of lily pads. Every day the patch doubles in size. If it takes 48 days for the patch to cover the entire lake, how long would it take for the patch to cover half the lake? Number of students said 24 days, when in fact it was actually the day before, on the 47th day. If it takes 5 machines, 5 minutes to make 5 widgets, how long would it take 100 machines to make 100 widgets? Good number of students said 100 minutes, when in fact it's 5 minutes. So clearly what this research shows is that we often make very quick decisions, even when confronted with logical questions like these. Let's talk about some of the other biases that we know influence our decision-making. One of the most common is called the availability heuristics. And basically what this is saying is we assess the probability of events based upon what's most familiar to us. So we skew those things that are most familiar. As an example, strokes cause almost twice as many deaths as all accidents combined, yet 80% of respondents judged accidental deaths to be more likely, right? We hear more about accidents than we do about strokes. Similarly, many people think that tornadoes kill more people each year than asthma, when in fact asthma kills 20 times more people. When it comes to behavioral finance biases, when we think about availability heuristics, it really, again, biases our assessment of risk. All assessment of risk requires a probability assessment. And again, we're influenced by recent events. One of the most common is this instinct to move with the herd. So it explains why people buy when it's too high. They hear all the positive news in a bull market, and that's when they start buying. And then unfortunately, when they start getting the negative news and we go into a bear market, that's when they start selling. The exact opposite of what a smart investor should be doing. Or the memory of recent events biases investment decisions. We saw that at a tremendous extent after the 2008-2009 financial crisis, when a significant number of people, particularly in their 401k plans and other kinds of investments, exited the equity markets for a very long period of time, which really hurt them because we know that the markets kind of rebounded quite significantly. We also see, not surprisingly, a good number of people buying insurance, after hearing about natural disasters. How things are framed also significantly impacts our probability assessments. So think about being confronted with this situation. You're talking to your doctor, you have an illness, the doctor is recommending 2 very innovative and new procedures. So which one would you agree to accept? Procedure A, we know that 10% of patients who opted for this procedure have died within 5 years. Procedure B, 90% of patients who opted for this procedure have survived after 5 years. So think about which one would you prefer? This question, or these questions, were actually asked to doctors. And interestingly, 95% of doctors said yes to B, 85% said yes to A, when in fact, these are exactly the same probabilities. You really should not see a significant difference like we see between these 2 results. I mean, there is a significant difference between 95 and 85%. And again, these are doctors that are making these decisions. So this is also based upon what we call anchoring. This really always blows my mind because I've seen it in so many different situations. And even in my classes, I've given half my students a randomly high number and the other half a randomly low number. And I just asked them to give me an estimate on some calculation. Invariably, the group that had the high random number gave me a significantly higher result than the group that had a low number. It's amazing to me. The research says that we get primed. That first number kind of primes us, even though it may not even be related to the question at hand. An example, students were asked these two questions. Now, first question, how happy are you? Second question, how often do you date? Interestingly, when they were asked in that sequence, the correlation between the two was extremely low. But when the questions were reversed, the correlation became significantly higher. Apparently that dating question primed their response to the happy question. So we see anchoring biases often when it comes to behavioral finance. We see investors getting anchored to 52-week highs and lows. We see people getting anchored by a stock increasing significantly after an IPO. Prospect theory, again, an analysis of decision-making under risk have a lot of implications for equity investments. So think about these two situations. In situation one, which would you choose? You have a guaranteed $900, or now you have a 90% chance to get $1,000. In situation two, you already lost $900, but now you have a 90% chance to lose $1,000, 10% chance to break out even. What we find is that in situation one, people are risk adverse, right? The subjective gain of a guaranteed worth is more than a gamble. Situation two, which is the mirror image of one, people seem to be risk seeking. The negative value of a guaranteed loss is more than the gamble. So in other words, we weight losses significantly more than we weight possible gains. We see this in what we call the loss aversion problem. So think about this. Let's flip a coin. If it's tails, you lose $100. If it's heads, you win 150. Now, this is a gambler's dream come true, right? There is a positive expected value, but we find that there's a good number of people who would not take that bet. Now, we see that there's what we call a loss aversion ratio. People typically need between 1.5 and 2.5 increase in gains to offset the prospect of a loss. And not surprisingly, if the wage was higher, if you lose $1,000 and heads you win $1,500, less and less people would take that bet. So again, we see people weighting losses much differently than how they perceive gains. And here's the classic example of a graph where you could see that the slope of losses is significantly steeper than the slope of the possible gains. So when we see this in relationship to behavioral finance, we oftentimes see investors holding losing positions much longer than they should, rather than feel the pain associated with just cutting your losses. We also see people selling their winners way too quickly. They want to lock in their gains. Another interesting bias we see, particularly in behavioral finance, is what we call the expert fallacy. This is particularly relevant if you're thinking about investing in a mutual fund or fund manager, and you're very impressed by maybe a 5-year, very positive run. And the question is, well, how likely is this fund going to achieve 5 good years in a row? What were the market conditions? What were the other factors? Or more importantly, how many opportunities, how many funds are out there? As an example, I can flip a coin 10 times in a row, and if I get 10 heads in a row, you would think that's exceptional. You would actually think that the coin possibly was fixed. But if there were 1,100 people flipping that coin, there's a good probability that one would get 10 heads in a row. So again, understanding what we call the base rates when making probability type decisions are very important. We see similar issues with this concept of regression to the mean, right? We overly rate above average returns. We don't factor in that there's some noise and even luck involved, market conditions and what have you. And we underrate underperformance. Similarly, we don't factor in what were the market conditions, what was the noise. Smart investors look at long-term averages. Smart traders typically benchmark off of the 200-day moving average, as opposed to getting influenced by these ups and downs. Another interesting bias we see is the status quo bias, particularly when investors are given a lot of options or too many complex choices. They seem to not want to move, right? They rather stay put because that takes the least amount of effort. This is very much related to the default effect, where many people will stick to default options, don't expend the energy to change, even if there is another option that's better. The classic example is people don't choose to contribute to a 401k plan, even if there is a generous company match, but they will allow the deduction if the default is automatic. We see this with organ donors. States that require you to check the box on your license, very few people check the box. But in states that automatically check the box, very few people uncheck the box. Similarly, we see this other effect that's called the sunk cost fallacy, somewhat related in that based upon how much time and effort we put into a decision, we tend to stick to that decision, even if it's no longer relevant, particularly when we make long-term investment decisions that may no longer be effective. People fail to maybe rebalance their decisions over a period of time. And also we see this phenomenon called mental accounting, where people kind of classify different kinds of investments differently psychologically. So as an example, they may treat an IRS refund as a windfall and not realizing that they have other pressing financial needs, or they're being too conservative in an investment account for their children's future education, may actually be getting a negative return, as opposed to realizing that all of the money is fungible and it really should be managed in a more diversified account. So interestingly, when thinking about equity compensation type programs, it's important to realize that employees want three types of benefits. There's the classic utilitarian. What does this do for me and my wallet? So how much will the employee receive? There's an expressive component. What does this say about me to others and myself? So who else is getting this equity, and how is that decision being made? And clearly there's an emotional component. How does this make me feel? What kind of an impact is it having on my long-term financial well-being? So some of the strategies that behavioral finance theorists recommend clearly is focusing on reducing these errors, maybe providing people with more financial facts, more information about these probabilities, alerting them to these pitfalls that we do sometimes, make these quick decisions that could be erroneous. We need to continuously activate systems too. And of course, many people also need help from investment professionals to help them make these very important decisions. Other things that I think are important is there's a lot of different kinds of equity examples that are influenced, or the decisions that employees make within these kinds of programs are influenced by these biases. So as an example, with stock options, we see sunk cost effect, where we get stuck on a particular path. Our commitment to it grows. We don't change when we should be changing. Or the loss aversion, where we prevent losses more than we try to realize our gains. That's could be offset by continuous communication and education, providing employees with very timely and accurate information. When it comes to RSUs, we see the mental accounting effect. Many employees view the equity as part of that compensation and maybe not part of a long-term investment strategy. So that should be really discussed in financial wellness programs, helping employees realize that equity is a big driver of long-term wealth accumulation. When it comes to performance shares, there is the status quo bias, where people get stuck behaving in a way they've been traditionally behaving. So clearly aligning strategic objectives, performance objectives with organizational objectives are critically important. And then, of course, similarly, what we saw with the 401k, we see the default effect also significantly impacting ESPP programs. These are just examples. There are countless other examples. Other things that I think are related to this is to realize that equity compensation is really one set of practices that's part of a systems of practices that create a culture. And many of the research that we've been doing at Rutgers has shown that a high performance ownership culture makes the most sense for those organizations providing equity compensation. It focuses on not only having effective compensation design, an educational component, a communications component, with the objectives of making sure that employees have the ability to accumulate wealth long-term. And clearly there are other important complementary practices and programs. So let's talk about some of these strategies. So when you're thinking about compensation design, one of the most important concepts is to ensure no wage substitution. Wage substitution pretty much negates all the benefits that equity compensation may achieve in engaging employees, enhancing commitment, and the like. So what wage substitution is, you're maybe financing equity by taking something away, whether it's an increase in pay or whether it's a benefit type program. I mean, critically important, companies that provide equity as a grant, under a discount, favorable look back, clearly that negates the issue of wage substitution. Many companies in our research actually do offer a combination of a diversified retirement program, a 401k plan, to also complement the equity program. This ensures that people have a more diversified portfolio. I think it's important to communicate. No one should really have more than 15% of a diversified portfolio in any given stock. And then the most powerful combination that we see, organizations that offer both long-term equity type programs complemented with short-term bonus cash programs. In those situations, we see employees clearly hold on to equity for longer term periods that helps them accumulate wealth over the years. Not surprisingly, it's all about education. Companies that provide financial wellness type programs, offer some kind of advice, communicate information to employees. Most importantly, letting employees know about two important risks. Interestingly, the first risk is not participating in equity. I think people need to know that when you see the wealthiest families, one of the reasons why they're wealthy is because they have large holdings of equity. Equity is a huge driver of long-term wealth. And then, of course, what we've already been talking about, the importance of diversification and managing risk. Clearly, if you're going to be offering equity and you want people to think and act like owners, it's critically important to share information. So we see companies that engage in information sharing, provide strategic information, financial information, things that are happening day to day within the organization. It also kind of helps employees understand the language of business. And there's a whole other body of research that shows this also enhances psychological ownership, which we know is highly related to employee engagement. When it comes to performance management, the issue is what we call line of sight. Employees need to know how their performance objectives tie into the group or the function, and how the function ties into the overall objectives of the organization. They need to see, right, how their performance is related to company performance. This clearly enhances this concept of ownership. And then if you, again, want people to think and act like owners, if you're going to share information, it makes sense to include employees in decision-making. This could be employee involvement teams. We see companies offering problem-solving work groups, self-directed teams. Clearly, this is part of also an open book management philosophy. Clearly, these practices create this culture that we know has significant relationships to individual outcomes, strategic and financial outcomes. And then not surprisingly, companies that provide training and development. It just makes sense, right? If you tying people's performance to the performance of the company, and that is going to have a direct relationship to the value of equity, enhancing the skills of employees to enhance their performance makes strategic sense. Interestingly, this combination of equity and training is also a significant component of a high performance work system. And there's decades of research that indicates that's so much related to these individual strategic and financial outcomes. Again, it also enhances business acumen. It clearly can be related to management and leadership development. And not surprisingly, this also enhances commitment, which again is related to engagement. And then lastly, having an effective communication strategy. I do a lot of research with different generational cohorts. Not surprisingly, different generations like to receive information through different media. Younger, more relying on text messaging, instant messaging. Older, more relying on emails and even flyers. But the key is to also realize there are pros and cons. Clearly very timely and accurate information makes sense for text messaging, emails, posting on websites. But you should also be complementing that with communication that's more dynamic and interactive, where employees could receive information, ask questions, and learn. That could be live presentations, streaming presentations, and the like, right? So thinking about a combination of delivery methods for these different purposes makes the most sense. So there's a large body of research, that does show these complementary practices with these kinds of organizational compensation systems that we talked about, creating this ownership culture, results in significant individual strategic and financial outcomes. So it really makes sense to be thinking about all these things, not only in the context of helping employees make good financial decisions, but also getting the most return on your investments in these kinds of programs. So that's a pretty high level overview. We have time for sure to maybe answer any specific questions you have about this topic, the topic on ownership, the culture. I mean, we do quite a bit of research on all of these topics, so I'll be more than happy to take any of your questions.
Thank you, Bill.
Thank you.
That was great. While everybody's thinking of a question that they might want to ask, and you can put it in the chat and I'll repeat it back to Bill. I'm going to ask Bill some questions, some frequently asked questions he gets asked that might be helpful for all of you while you're thinking of your question. The first one is how can companies help employees make better financial decisions saving for retirement?
Well, a lot, I think, of these complementary programs. Again, the educational financial wellness component is really important. Letting them know the importance of equity as a long-term strategy. Again, don't think about it as part of your compensation where you cash out and use that like you would use your normal compensation. Equity is a long-term driver of wealth, and maybe having that combination that I referred to, a short-term bonus plan with a long-term equity component.
Right. Thank you. One other one I know you get asked often is what type of equity do you recommend companies give to employees?
Well, I think it's not so much the type of equity, but how you're offering it, going back to no wage substitution. So clearly, organizations that provide equity as a grant, there's no risk involved for employees at all. So that may motivate them to hold on to that equity for a longer period of time, possibly as a discount. favorable lookbacks, if you're providing options. The key strategy is to reduce employees' risk, right? Companies that require individuals to invest in the equity type programs, there may be more of an inclination for the employees to look at that as a short-term investment. I'm going to cash out and complement my overall compensation, as opposed to, again, here's a component of my portfolio in equity that I'm going to hold on for the long term.
Makes sense. I don't know. This is kind of a small group. Does anybody but want to unmute themselves to ask a question? I feel like we could do that.
Hey, Bethany, this is Rob Wright. Bill, I have a question for you, actually. In terms of pensions, I know they've kind of fallen by the wayside in the past, a couple of decades, I guess. Really defined benefit plans aren't really a thing really anymore, but they are definitely out there. I wonder if you explored maybe the difference with organizations that still have like a defined benefit program, and see if there's any kind of significant difference in terms of how they approach their equity plans and employees' responses.
Yeah, I mean, that's a really good question. I mean, clearly, overwhelmingly, to the point that you made, most of the research that we see, companies are offering defined contribution programs, the ones that are offering equity, 401k plans and the like. Many companies that do offer defined benefit programs, I don't see a whole lot of equity participation. And again, that could just be a selection bias, that there are that many companies, that are offering traditional defined benefits. I mean, you see them in government kinds of positions, heavily unionized type work, oftentimes do have defined benefit programs. But to my knowledge, in the research that I've done, I haven't seen defined benefit programs being used complementing equity participation. And again, it could just be the fact that there's a smaller number of them than there are organizations offering defined contributions.
All right, thank you.
Anyone else like to unmute and ask their question? Going once, twice. Okay, that was great.
Well, this was a small group, but I hope you found something interesting about the research. Gives you food for thought about maybe how to design your own equity compensation type programs. You can clearly come to our website at ownership.rutgers.edu. There's a wealth of information, our research. We have a number of webinars, recorded sessions on a variety of topics that I think you'll find very helpful on this broad topic of employee ownership. So not only do we deal with equity compensation, we deal about other forms of ownership like ESOPs and worker cooperatives. And then importantly, we just rolled out this free employee ownership online education program. So this basically is designed to help organizations think about using employee ownership as a business succession tool, in essence, selling your organization, your company to employees. Again, using either an ESOP or a worker cooperative type strategy. So if you know business owners that are maybe thinking about these kinds of strategies, or you're just interested in this topic yourself as part of an educational process, feel free. It's a free program. Again, you can go on to ownership.rutgers.edu and you'll see the segment within the website that is the employee online education program. Just click it. There's an ESOP module and there's a worker cooperative module. And again, this is a series of webinars that we put together usually on a monthly basis. Our previous webinars are recorded and are available for you to see. And hopefully we'll be coming out with some more interesting topics in the future. So thank you very much for logging on today. I enjoyed the opportunity to present this research.
Thank you
Have a
so
good
much,
day.
Bill. Really appreciate it.
Thank
Just a
you.
reminder to everybody, I will be sending a recording of this presentation. If you're able to attend, which you're here, and also to the people who weren't able to make it, I'll be sending it out to everybody. And it also will be accessible on our website within about 24 to 48 hours. So look for that email from me And if you have any questions, if there's any topic that you are interested in that you'd like us to develop, or if you just have any questions at all for about the center, you can direct them to me or email Bill or Jim Terez directly. So thank you all for your time. We really appreciate it. Have a great rest of the day.
Thank you, guys.
Bye.